listen to it. Let's listen to it.
Hi, this is James Studinger. Back in 2008, we had this crazy financial crisis collapse where everything seemed to be failing. And it really shook the industry because we grew up under this idea that with diversification and asset allocation, you could kind of protect some assets against what was going wrong with other assets. And there was very little protection at that time. It seemed like everything was failing. And the reason everything was failing is because that we had a debt problem. When we found out when you have a debt problem, you got an everything problem. And at that time, I realized that I needed to get much more intimately involved in understanding the macroeconomics driving our country. And so I started downloading raw data directly from the sources, the Federal Reserve, the Treasury, the IRS, BEA, government agencies that were responsible for collecting the raw data. And those were the agencies that everybody else took the data from, analyzed, cut up, and gave their own analysis about. And the industry, and even myself back then, we got most of our information from people that had analyzed the data or analyzed what somebody else analyzed of the data or so on. So sometimes what we saw was 3 or 4 times removed from the source. And I needed to get right back into the source. So in 2008, in 2009, I really expanded on that. And I went back to the 1980s in the collection of the raw data because I wanted to see a progressive analysis of how did we get to where we are then, where we had so many bankruptcies and foreclosures in our country. What brought that about? And what I found was that we've got primarily 3 drivers to the economy, as I broke it down. One, you got households, you have businesses, and then you've got the federal government. And in the 1990s, we had a business-driven economy. The internet was coming to be, and suddenly you had this worldwide stage to sell your goods at, instead of having to have somebody come into your local store and do their shopping. And we didn't know how to measure that, and we didn't know what the potential of that would be. And things got kind of carried away with stock valuations. It all came crashing down in 2000. George Bush came in as the president, and him and Alan Greenspan as the Federal Reserve. And they initiated a household-driven recovery. They dropped interest rates way down. I remember mortgage rates got below 6%, which at the time was really crazy low. Most people have never seen that before in their lifetime. Now that seems kind of high, but back then it was super low. And the encouragement was to get people to go shopping. And we basically bankrupted America, Americans. Car companies started offering 0% interest rates. We had 0% interest rates on furniture and other things. And I remember hearing advertisement on the radio over and over again. No income, no credit, no problem. Too many people were taking out way too much money and bankrupted themselves. We learned what foreclosures were and short sales and stuff that most people had never heard of before. Certainly most people never thought they'd experienced it before. So then Obama took office in 2009. And we started what became the government-driven economy, where the Federal Reserve, what we refer to as printed money, where they bought a lot of debt out there in the marketplace because there was no confidence in debt. And the Federal Reserve came in and said, this debt is not going to decline to nothing. It has a value, and we're going to declare that value because we're going to buy it. That's what they call printing of money. And interest rates dropped even further than they did before. And the government came out with a ton of stimulus packages and programs to put more money into the system. And that went on for a very long time. And during that time, I started to get nervous about what I thought might be the third bubble. We had the business-driven bubble. We had the household-driven bubble. Were we going to have a government-driven bubble? And the years went on and the years went on, and it never seemed to materialize, thank goodness. But the metrics continue to get worse and worse and worse until we get to the point where we are today, where things that looked horrible actually kind of are horrible, but now you can't ignore it anymore. And now I think we're going to enter a new stage, hopefully one that doesn't involve the government having to have a failure, but a stage that we can move into more gracefully, where we can get back to a consumer in a business-driven economy that's sustainable while the government has time to work and clean up its own balance sheet. So I'm going to go through these charts and explain them to you so that you can have some context, like I have been giving myself for many years, about how we got to where we are. Exactly where are we? And what is a path forward that could look attractive? I've always believed that wealth is a choice, and part of that accumulation of wealth comes with having more knowledge about what's going on around the world. So let's spend a little time today looking at what's going on around the world. So I wrote this article, Something Needs to Change. It's got a lot of charts and information in it, and these charts sometimes can be easier illustrated through a video. So this first chart shows a normal trend and a not normal trend. The normal trend shows since 1980 the growth of GDP. GDP is our economy. When somebody says our economy is growing, that means GDP is going up. Somebody says our economy is declining, that means gross domestic product, our economy is going down. Income at the federal level should grow relative to GDP. That would be very normal. Just like your income should probably grow somewhat relative to the growth of whatever company you work for. The spending at the government level has been far excessive of a rate than the rate of income. And the spending is the orange line. And you can see during any period of recession that the government does have to step in and fill the gap. Because during a recession, income falls for the federal government. People aren't making as much money, and so the government doesn't collect as much revenue. And expenses rise because people need help. And so they have bigger bills and less income, and they create a deficit. And you can see in the year, after the dot-com crash, revenue went down, but spending remained constant, and the government had large deficits in order to compensate for that. And then you can see after the financial crisis here in 2008, we had a big drop in spending, in income, but a big increase in spending as the government had to fill that gap. This era here went on for a long time, and we accumulated a lot of debt during that time. Then we get into COVID in the year 2020, and we amassed a tremendous gap. We basically shut down the whole economy for the most part. So we had a tremendous gap in spending relative to income. But then even after we got out of COVID and we recovered from that drop of economic growth and we had some expansion again in income and spending, or income and GDP, our spending continued to have this huge gap between what we earned and what we paid for at the government level. Here's what it looks like in terms of income to the government, spending, and deficits. So a deficit is the gap between what the government collects which is this blue line. It's what they collect, and what their bills are, what they spend, which is the top of this orange line. And anytime there's a gap, you have what's called a deficit. The only time during my lifetime and during this chart that there was a balanced budget was very briefly, right before the Y2K .com bubble burst, whatever name you want to give it. Even during that time, it was very brief. It was a couple $100 billion. And we quickly hit a deficit again. We got into a recession and we very quickly had a deficit. If you add all the deficits up together, you will get to what our debt is. Our deficits are the gap between spending and income. Our debt is basically an accumulation of all of our deficits over time. So this chart shows federal debt, which is this blue line, and the orange line is the interest that we pay on that debt, like that. We have about $36 trillion of debt, a little more than that now, and it's going up recently by about $2 trillion a year. And the interest on that debt has now gotten to about $1.2 trillion, which is tremendous. But an interesting thing was going on over the course of all of these decades while this debt was getting out of control. In 1995, we had about, let's see if I can get rid of this pen. In 1995, we had about $5 trillion of debt, and our payment on that debt was $350 billion. In the year 2016, we had about $20 trillion of debt, but the payment on that debt was only $454 billion. Now, I say only $454 billion, it's a lot of money, but it's only about $100 billion more than it was when we had $5 trillion of debt. So the math is that our debt increased by 300% from $5 to $20 trillion, but our payment only increased by 35%, went up by about $100 billion. So even though a payment of $477 billion is a lot of money, as a percentage of our budget and as a percentage of our federal income, it was a lower percentage than it was back when we only had $5 trillion of debt. So over these years that we were accumulating these tremendous deficits, it was like it was no big deal because the obligation was becoming an easier and easier to pay, which doesn't seem like that should be normal, right? But there's a very good reason for it. And we got to the point where reality has hit us, which is we now have a debt payment, an interest payment of about $1.2 trillion. And I'm going to give you this as a very disgusting analogy, but I think it's pretty appropriate. So what happened over the years is, if you think about it disgustingly, over in Washington, D.C., if you will, everybody that works there in a room can see that there's this little pile of dog crap on the floor. And somebody goes over to the dog crap and they see it. Doesn't look very good. And they put a glass bowl on top of it and cover it up so you can't smell it. And it doesn't look good, but you can't smell it. And so it doesn't seem like, other than being a little bit of an eyesore, it's that big of a problem. And each year, the little pile under that glass bowl gets a little bit bigger, and it gets a little bit bigger. And new people would go into Washington, D.C., and they'd say, does anybody else see that pile of dog crap sitting there in the middle of the room? And somebody would say, yeah, I mean, don't even think about it. It's no big deal. We got a glass bowl over it. You can't smell it, so it's not hurting anything. And don't worry about it. It's no big deal. And in the beginning, it probably seems like it is a big deal, but the longer that people work and operate over there, I think it becomes less and less of a big deal. And anytime somebody would bring up the fact that, does everybody realize that there's this pile of dog crap in the middle of the room with a glass bowl on top, and that's why we can't smell it, but it is still, kind of disgusting, and it's not good, and it's getting bigger every year, and we're not doing anything about it. And someday it's going to be bigger than that bowl, and we're probably going to start to smell it, and we should probably do something about it. Everybody just keeps dismissing it. It's not a big deal, not a big deal, not a big deal. Eventually that pile got bigger, and it got bigger, and it got bigger, because that's what was happening. It was getting added to every year. It was never being taken away. It was never being cleaned up. And the glass bowl is only so big. And at some point, everybody knew it was going to be bigger than the glass bowl. Everybody would smell it. And at that time, you'd have to do something about it. But nobody wanted to do anything about it until that time came. Well, that time finally came, because the glass bowl is driven by, in our reality, interest rates. Interest rates, in this represented as this orange line, dropped tremendously from the 80s through the 90s, through the 2000s. They just kept getting lower and lower and lower. And even when they got down to a point that was so unbelievably, unimaginably low prior to COVID, they got even lower when we had to deal with COVID. They dropped to near zero. And even though we kept accumulating more and more and more debt over these years, this debt kept going up and up and up and up and up. The payment on that debt remained relatively unchanged, considering how much more we had. 2 times more, 3 times more, 4 times more. But the payment remained relatively unchanged. And even in COVID, even though we took on so much more debt in the beginning of COVID, the payment actually came down because interest rates went even lower. And so we had a little bit of a reprieve yet again. But once we got out of COVID, interest rates became more normal again, normal at a very low rate. And now the debt has ballooned, because it was always going to happen. It was just simple math. When you have a lot more debt at a higher interest rate, that payment is going to go through the roof. And that's what it did. And that little pile of dog crap that was in the room that everybody ignored because they couldn't smell it, because they had a glass bowl on top of it. They could kind of see it, but they'd cover it up every once in a while with flowers or something. You can no longer ignore it. And now something has to be done about it. And the sick reality about this payment is that it's never going to go away. The only way that we would ever reduce our debt, this $36 trillion and growing, is if we didn't have a deficit. And the only time we didn't have a deficit was way back here. We had a little bit of a surplus. Even then, for some reason, they didn't pay down the debt. They did other stuff with that surplus. I don't know why they didn't pay down the debt, but they didn't pay down the debt. So this $1.2 trillion payment, which is our new reality, keep in mind our entire income at the federal government is about $5.5 trillion. So it went from being this kind of insignificant, not really insignificant, but kind of insignificant part of our budget to being a tremendous part of our budget. All of our debt payment is borrowed. Last year, we had a $2 trillion deficit, and we have a $1.2 trillion payment, which means that we don't have enough money of income to make our payment. We have to borrow all new debt just to make that payment. And every time we borrow debt, we have a larger payment. It's just simple math. For example, if you have a $1 trillion deficit and you borrow an additional $1 trillion of debt and you pay 2% interest on that, you're going to pay $20 billion of interest, let's just say for the rest of eternity, if you never pay it off. If that debt is borrowed at 4%, then you're going to pay $40 billion of interest on that debt. And you didn't get anything for it. You had to borrow the $1 trillion just to make a payment on a debt of $36 trillion. And so there is no gain whatsoever. You're not a bigger, stronger, more capable country than you were the year before. You're in worse fiscal shape than you were the year before. And you're going to keep doing that every year that you have a deficit. And there is no end in sight to eliminating this deficit because the rate of spending has far exceeded the rate of government income for a very long time. So that's the big, bad, scary reality that we're now faced with. I think it represents a very big problem and something that I've been worried about for quite a long time, but it hasn't been a reality that we're faced with until the very simple math happened, which is the interest rate on the debt went up. It was inevitable that that would happen, and it finally did. I want to talk about another problem that we've had developing in our country for a very long time. And this has to do with the distribution of income in our country. So the IRS groups taxpayers into different categories: the top 1%, the top 5%, the top 10%, the top 25%, the top 50%, and the bottom 50% of taxpayers. And here I've taken their metrics and I've broken them down. And you can see over the years, the top 1% of our country's income right here has grown substantially, where they went from making up 7-ish% of our national income to they got over 25% of our national income. And now they're around 22, 23% of all national income is held by just the top 1% of taxpayers in our country. So we've got about 1.5 million people that make up that top 1% of our country's tax returns. And a tax return sometimes represents an individual, and sometimes it represents a couple. We've got roughly 340 million people in our country. And what that means is 0.4% of the population of our country earns almost 25% of all of the income in our country. That's not a very attractive looking metric. And that's a lot different than it used to be decades ago. If you look at the top 5%, you see another upward trend. This orange line, where they have gained more as a percentage of national income than they had back in 1980. And if you look at all the other income bracket levels, they're on the decline, especially the bottom brackets. The bottom 50% of our country used to make up about 17, 18% of income, and now they make up just over 10% of income, of national income. Between 25 and 50%, what a lot of people would consider to be the middle class in our country, used to make up over 25% of our national income, and now they make up about 17 or 18% of our national income. We've had declining trends of national income and who has benefited from that national income for many decades. This next chart shows the tax as a percentage of total tax collected. So what I did here is I said the top 1%, how much of the total tax revenue that the government collects from taxpayers, how much of that does the top 1% pay? 5%, 10%, 25%, bottom 50%. And here you can see that in 1980, the top 1% used to pay about 20% of our total tax collected from tax returns, and now they pay 40%. Across the top 5%, you see a similar trend, but not as aggressive. They went from paying under 20% of the total tax bill to paying over 20% of the total tax bill. Now, you'd expect those trends to take place because, like we showed here, they are the ones that are benefiting from more income over the decades. However, this is a very unhealthy allocation of where our federal government money comes from. And one of the sayings that has been said for a very long time, and I can't stand it because I think it's incredibly misleading, is when people say, namely politicians, if people just paid their fair share, referring to the wealthy people in our country, the wealthier people in our country. Number one, I think that that is extremely misleading because the top 5% of our country pays about 63% of all of our taxpayer income. I don't know how much more proportionately would finally constitute as them paying their fair share. To me, that sounds like that is a fair share. And it is a larger obligation that they pay relative to the percentage of income that they receive. But more importantly than that, statements like saying and referring to or inferring that this government deficit problem we have is because there's part of our society that is not paying enough taxes, the top 1 and 5 and 10% of our country. And that's why we have a deficit, is how it's usually heard by other people. And I think that that is a very dangerous and misleading statement to make, because that's not why we have a deficit. The other thing that is misleading with that statement is that it's not healthy that we have such a large tax burden on the backs of a very small percentage of our population. And it's not that it's unfair to those people, it's unfair to the other 75 80, 90% of our country. And that the problem is that they have been losing on national income. And the reason that the rest of our country doesn't pay more in taxes is because they don't make enough income. And to say that we need to focus on collecting more money from a very, very small percentage of our country is taking away from the reality of what the effort should be. And that is, we need more of our country, of the citizens of our country, to make more money. I had somebody comment to me when I mentioned this, that the bottom 50% of our country only pays around 2% of all national income. And I'm saying that as if that's not a good thing, and that it's not a good thing, but that's not at the fault of the bottom 50% of our taxpayers. That's the tax code. It's because they don't make enough money. The bottom 40% of our taxpayers, they don't even pay taxes. They have tax credits, which they are actually getting money back. So the bottom 40% pays negative 2% of our entire tax bill, meaning they're getting money back. And when I make that statement, some people can hear that as a negative thing toward those tax credits or that bottom 40%. And I'm not saying it that way. I don't want it to be heard that way. I believe in welfare. I believe in tax credits. We have all received welfare during our lifetime, all of us. Whether we got that welfare as kids from our parents, from relatives, from friends, whether we got some help in college or in school, whether we got that welfare from a state government, a charity, or the federal government, at different periods of our life, for different lengths of time in our life, we have all needed and benefited from welfare. It's extremely important. And these tax credits that these people are receiving, which helps reduce their tax burden, and in some of these cases, make it so they actually get money back and don't pay anything at all. They actually receive money. It's not bad that these credits are there. I just want them to make more money in the first place. We've developed a system where we are subsidizing the expenses for people rather than a system where people are getting ahead financially in life to the degree that they deserve or that they could. These pie charts show some of that data in a more visual way. In 1980, the top 10% of our taxpayers made up about 32% or so of all national income. And the bottom 50% made up almost 18% of national income. The middle class made up about 25%. Now in 2022, the top 10%, this is a very small percentage of our population, because it's the top 10% of taxpayers in tax returns, not our population of our country. So it's even a smaller percentage of our population of our country, make up about half of all national income. And the middle class only make up about 18% of national income. And the bottom 50% only make up about 11% of national income. In 1980, the top 10% of taxpayers paid about half of the tax bill. And now the top 10% in 2022 of taxpayers pay almost 75% of the entire tax bill. This is a very unhealthy distribution of income, and this is an extremely unhealthy distribution of tax liability in our country. And if you think about it this way, if you ran a business, any entity, and 75% of your income came from roughly, 5 to 10% of your customers, you are extremely subject to bad times if anything wrong happens with that very small percentage of your customer base. A healthy government, a healthy country would have a much bigger diversification of its own income, in that the tax collected across its society would be much more evenly distributed and more relative to the distribution of that income. And here's where we've got the two problems. The distribution of income has become way too biased toward the very top percentage of our country. This is the top 10%. This makes up an additional 25%. So this represents 25% of our country, making nearly 75% of all national income. And then here you have that same 25% of taxpayers paying nearly 90% of all our taxpayer income. That's not a healthy allocation or a dependable allocation that you would want to build the country's finances around. As a result of that information, and if you look at this chart, as a percentage of income, everybody pays less today than they have in a very long time. And I look at charts going all the way back to the Great Depression, and basically we have the lowest tax rates today than we've had in basically the last 100 years. And as illustrated up here, we have the worst fiscal balance sheet than we've had in the history of our country. And when you take those two scenarios, there's an opportunity for you to realize. Years ago, when we started saving into retirement plans at work, like a 401k, IRAs, and 403bs, and 457 plans, the only option that people had was to save pre-tax into a retirement plan. And that's not the case anymore. Now, just about every employer, I've hardly seen a single one that doesn't allow it yet, has a Roth workplace retirement plan. So in your 401k right now, if you were to look at it, you're probably saving pre-tax in your 401k, unless you're one of our clients, because we've been hammering this for a long time. You now have the option to save that money as a Roth in your 401k. And I highly recommend that you make that change. We've got a lot of videos on our website that go into much more depth on that subject if you need to be educated on it. You would make that change at a time when we have the worst fiscal balance sheet in the history of our country that needs to get fixed. And we have the lowest tax rates basically since the Great Depression. I think it's incredibly logical that we will have higher tax rates in the future. And I think that that is necessary in order for us to get any handle on our fiscal balance sheet. And so right now you have an opportunity to contribute money as a Roth instead of pre-tax, so that later on in life, when those tax rates are higher, whatever money you were able to contribute into that Roth between now and then and distribute in retirement will not be taxed. And that'll shelter you from that burden. Some people might also convert money from an existing pre-tax retirement plan and move it into a Roth IRA, and then let that invest and grow and double or maybe even triple. And after it's worth a lot more money than it is today, to take that money out in retirement and start to spend it. And that's an opportunity that you have today. And I would take advantage of that today while we have this fiscal situation going on. And by the way, it's not only an opportunity for you, it's also an opportunity for our federal government and its poor money management. Because if less people saved pre-tax into their retirement plan, and I think nobody should save pre-tax into their retirement plan, then that means that there would be more income tax to collect, which means since the government collects a percentage of income, that they would have higher revenues. And those higher revenues would make some productive effort toward closing our deficit. And if people converted, that would create some really big chunks of income. So now we've got these problems. We've got this deficit problem at the federal level that's been happening for a long time. We've got this income disparity that's been happening for households for a very long time. Let's look at some of the other things that are happening and are being addressed today. Global trade balance. You've heard this talked about a lot recently. It represents the deficit, a trade balance. In our case, we have a deficit with other countries around the world. So what that means to have a deficit is that other countries export more of their goods and services into our country than we export our goods and services into their country, meaning we import goods and services from countries around the world at a much higher rate than we export our products, goods, and services out to the rest of the world. And our trade deficit is measured in two aspects: goods and services. Technically, we are a net export of services. So our trade deficit is right around $1 trillion, at least in the year 2023. But our goods trade deficit is 1.2 trillion, because we're somewhat offset by the services that we supply for the rest of the world. And those services are financial skills that America has and technological skills, tech skills that America has. If you look at the goods aspect of it, what's being talked about a lot lately is our lack of manufacturing in our country. And this chart illustrates that. There was a time, this is back in 1947, 1951, where we were producing over 25%, manufacturing made up over 25% of total GDP, which is our economy. And if you look at it today in 2023, it makes up right around 10%. And we've all seen it in all the towns, wherever you live, all the manufacturing plants that have been idled. And I see it in Michigan, in the automotive capital of the world. That's a hat, something we hang our hat on, but it's not really true anymore. It was a long time ago, but not anymore. And I've got on either sides of me Detroit, and north of me is Pontiac, and north of that is Flint. And all three of those cities were once booming, manufacturing, worldwide production companies, thriving, flourishing back in their heyday. And now they're riddled with closed plants that have been closed for decades and still sitting there, many of them, idle, and maybe never to be turned on again. We've had this loss of manufacturing jobs in our country as we've relied on most of the rest of the world to produce our goods. And nobody did it more than China did. And I don't know if tariffs are a great idea, a great solution or not, but I know something needs to change because this is not a healthy trend. And I've heard people say for a long time, especially being here in Detroit, from Detroit, a lot of people in the automotive industry, that we require a global supply chain, that we'll have a part made in some other country, brought here, assembled, shipped back out to some other country again for another part to be made or assembled or put on it, brought back here again, sent out, brought back, that all the components to put a vehicle together come from various other countries, and sometimes those components are shipped to different countries in and out of our country numerous times before the vehicle is finally assembled and sold here in America. And I'm told that that's necessary in order for us to be profitable. I'm in finance. I'm not in manufacturing. I've never been in manufacturing, but I've got one very obvious statement to make on that, which is Tesla, which is the most American of our American car companies at the moment, as far as I know. They make a lot of their vehicle in America. I've researched, it looks like up to about 75% of the vehicle is made in America. They are in or near the top 10 most valuable companies in the entire world. Earlier this year, they were worth around $1 trillion, and they're worth a little bit less than that today. But GM and Ford combined have a market cap of less than $100 billion. Right around 10% of the total market cap of Tesla, which manufactures most of its vehicle here in our country. And so if the argument is that it's impossible for us to manufacture vehicles or other things in our country, how does another company do it? And not only do it, but become one of the top 10 most valuable companies in the entire world, let alone just our own country. I've got a patent on a gambrel, which is a item used to in the processing of game animals, namely deer. And it's the biggest change to the gambrel since the invention of the gambrel itself. There's really been no change over the decades. And it's the best one out there. I don't mind saying that. I want to get it manufactured in our country. I got the patent a few years ago. I have not been able to find a manufacturer in our country yet that can do it anywhere close to even the price that you could buy a gambrel at a store like Cabela's. They sell like Cabela's for like $25 each. And most of the prices I see around manufacturing it are right around $100 each, which means that I'd have to sell it at the store for like $200. And it's a simple piece of equipment. And it blows me away that we don't have, at least I haven't been able to find, a single manufacturer in our country that can do that production anywhere close to what even the retail sale is at a store. It doesn't make sense to me. And I look at the $30 trillion of new debt $33 trillion of new debt that we've taken on since the mid-90s. And this debt that went to all kinds of projects, you know, green energy, stimulus, supporting other countries, wars, some infrastructure, obviously some of it just to pay debt. But I look at that $33 trillion and how has none of that over the years apparently gone to an effort to just help America be a manufacturing powerhouse again. Which, by the way, would be a lot greener manufacturing here in our country than how it gets done in a lot of other countries. The energy would be greener and the working conditions would be dramatically better for those employees in America than they are elsewhere. America, as evidenced by Tesla, does know how to produce things. I got another company I absolutely love, Reconyx. They make trail cameras. This picture of these two wolves is a picture captured by Reconyx. I put trail cameras up in the Upper Peninsula. I've had them out there for like 15 years. And mostly I have Reconyx trail cameras, and I've used a few others. Reconyx is the only one that I know of that's made in America. And all of my Reconyx trail cameras work flawlessly. They've taken thousands and thousands and thousands of pictures through all of the Upper Peninsula elements out there for 12 months at a time in the snow and the ice and the rain and the sleet and the sun and the heat. And they work flawlessly. And some of the other cameras that I've used have failed and don't work nearly as well. They're not reliable. Reconyx is by far, in my experience, the best trail camera in the industry. And they're made in America. We do know how to make things. We do know how to produce things. And we can do that in a much greener, safer, more humane, good working condition than what happens in some other places. If we don't do anything different, so I think we got a problem with our government spending and income. I think we've got a problem with our lack of manufacturing, and that we've relied too heavily on being a technology and a service industry and not enough on an industry that still produces things. I think we've got a problem where we've got too much of our income as a national level is isolated at a very small select group of our citizens. I think we've got a problem where too much of our income at a national level, 75% of that, is paid for by only 25% of our citizens. And even more scary than that, 62% of that income is paid for by only 10% of our citizens. I think all of those things represent awful metrics for a sustainable and a strong and a sound government in a country for decades to come. What this chart illustrates is if things don't change, if we keep going along the same path, what that might look like. So a deficit can be calculated very simply by just a few metrics. GDP, and what does GDP grow by? What percentage of GDP do we collect as tax revenue? And what does federal spending grow by? And currently, these are fair metrics to each of those. GDP grows at about 2.5%. We collect taxes as a percentage of GDP at about 17%. And our federal budget grows at about 6% per year. And if those same metrics continue forward, the ones that we've experienced for quite a long time now, if those same metrics continue forward for the next decade and the decade after that, Then our federal income will be this orange line, which is not very aggressive. Our federal deficit will be this blue line, which is very aggressive and disturbing. And our federal budget will be this green line, while GDP continues to grow. So income grows, but it's only a percentage of GDP. And where they could grow at the same rate, they don't grow at the same dollar amount. But if the federal budget exceeds the rate of growth of income, as it is today, this deficit of $2 trillion becomes unbelievable in the future. And I don't think at all sustainable to see a deficit of 50, 60, or 70 trillion dollars. I think it's safe to say something would have broken by then. Here, changing those metrics just a little bit shows that there is a different way forward. You got to change those three things. The rate of growth of GDP, I believe the percentage of tax of GDP, I don't think that that can be ignored, and the rate of spending at the federal level. And in this example, if growth of GDP was at 5.5% instead of 2.5%, and if instead of taxing 17% of GDP, we tax 19% of GDP, which means we all pay a little bit more in taxes, and if instead of growing the federal spending by 6%, it grew by only 1%, then by the year 2041, we would have another balanced budget, which we haven't had since basically 1999. And moving forward, if those metrics remained, we would have surpluses that would continue for many years to come. There's been a lot of press time given to DOGE and the effort to reduce the federal spending. And that's created a lot of angst and emotion and some anger from some people. I don't agree with the angst and the anger, because I personally believe that no matter who is running DOGE or what the name of it is, that we need our departments to look for efficiencies and ways to cut spending, because we're not on a sustainable path. But the reality is they've only found about $150 billion of efficiencies and cuts. And we have already spent more than that in increased spending this year. So the fact is that we are not reducing our spending at the federal level. And in this example, I'm not suggesting that we will reduce our spending, because I do not think that that is reality. I wish it was reality. But even the uproar of an effort to try to cut some program was met with such angst and anxiety and disfavor by so many people. I think it's just not a reality that we are able to do that. Instead, what I hope we at least can do is cap the rate of growth of our spending so that it grows at a much slower rate than our revenue does. And we're able to close that gap on the deficit as illustrated by this blue line. I think it's inevitable that all three of these metrics need to change. We need to grow at a faster rate. We need to tax more than we do today. And we need to slow our spending down. What this chart shows is if you don't make any changes, if we keep going at the rate that we're going, this blue is our debt. By the year 2060, we're over $600 trillion in debt. Like I said earlier, somewhere along the way, I think we have hit failure. This is not possible. So somewhere, sometime along the way, change is necessary, and I think that time is now. This yellow line represents that alternate scenario where we are reducing the rate of spending, we're increasing the tax sets collected, and we're increasing the rate of growth on our economy. If we can do that, then I think we can look at a future that is extremely sustainable and exciting and supportive for all of America, and not just this isolated group at the top tier of our income. I don't know exactly how they're going to get there. I don't know if tariffs are the perfect solution or even a good solution, but I am thankful that the discussion is being had and that these things that I'm sharing with you today are not new concepts to most people anymore. Most people still haven't seen the gravity of it, but most people are now more familiar with the fact of we have a really big interest payment. We have a lot of debt. We have a really big trade deficit, and we have an income disparity in our country, and that all of these things are not healthy, and that these things need to be fixed. As reckless as the appearance and politicians have been with spending over my adult life, that reality, and that ugly analogy I gave it of the dog poop in the middle of the room, you can't ignore it anymore. That reality has hit us because the interest payment is now not nothing. It went over $1 trillion and makes up a huge, substantial part of our budget. And it's disgusting because it never is going to go away. And it will never become less. It'll always be more because we do not have a surplus, we have a deficit. And 100% of the interest is borrowed, which means that we don't even get any benefit for it. We borrow more money, which we will pay interest on for eternity. And we don't build or produce anything with that deficit. It just goes to pay for prior deficits, which I don't know that they really produced anything either. I do believe in our system. And so I do believe in the checks and balances, as misguided as a lot of decisions have been over the decades. I think at this time, we've got this reality now that you can no longer ignore. And I believe in the checks and balances of our system. I believe that Republicans and Democrats check and balance each other. I believe that the judicial system is a phenomenal check and balance to both of them. And I believe that the American people are also a phenomenal check and balance within that system. And the pendulum in our country is always swinging. And there's always a large percentage of our population that thinks it's uncomfortable and it swings, and another part of our population thinks that things are wrong or uncomfortable and it swings again. And that's always happening. And now we're in the middle of another swing. But what I hope happens is that as we're swinging, that we make some real positive headway toward these numbers that have become quite disturbing. These are some things that you can do productively at a time like this. I already talked about the Roth. So start positioning your retirement money, because keep this one simple thing in mind. You save money to spend it, not just to have it. So put your money into a position that will be all yours. That when you take the money out, you get to spend it and don't have to give any of it away to taxes. Other things that we can do in this volatile period that we're in right now, if you're not retired, volatility is always your friend. It is an opportunity for you to buy more shares at depressed prices. Sometimes it's like going back in a time machine. If the market drops 5 or 10 or 15%, that gives you an opportunity to buy shares of something you wish you had bought a year earlier. And so for all the pre-retirees out there, volatility is your friend. And I know we'd all love to see a portfolio 401k balance be worth more every day than it was the day before, but that's not reality. And while you're saving into it, use that to your advantage. Retirees have a little different scenario. They're not buying into a volatile market. They've done all of their buying. Now they're pulling out of their assets for their retirement. And what I would say with retirees is make sure that you always have assets available to pull from that are not in the stock market. In our practice, I call that the 10-year burn rate. I look out at a decade worth of distributions, and I try to see how many years of that decade do we have covered for people to withdraw money from their portfolio and not take it out of a volatile asset like a stock mutual fund or a stock or an ETF, something that goes up and down wildly when the market goes up or down. Both pre-retirees and retirees can look at Roth conversions. It may be more opportunistic for a pre-retiree, but it also might make sense in some cases for people that are already retired. And then look for opportunities. I believe it's inevitable that we're going to go through some transition and change in our country. And I think that this has been developing for years. And I think that we finally got to a point where it can't be ignored. And so change is inevitable. One of my really good college friends told me that the one thing that people protect against the most are change and loss. And the thing that is unavoidable in life are change and loss. And I think that a lot of people have been losing for a long time in our country, been losing a share of income and been losing a share of opportunity, and that they've had more and more of their life subsidized than they've had more and more of their life as an opportunity for them to go capture for themselves. And now this change can be a good thing for them. So I would encourage people to embrace the change. I think at some point math is math, and you got to recognize that. And you have to realize that the next 10 years need to look different than the previous 10 years. And your job might look different. Your opportunities might look different. Your day-to-day might look different. And look for those changes as an opportunity rather than fight them, because I think it's inevitable. And that is probably a really good thing for most people. Detroit has a saying that you see on a lot of t-shirts, and that is that Detroit hustles harder. I kind of like that saying, and I think it's true. I think we need all of America to embrace that saying right now. And I'm seeing people having to hustle a little harder with the uncertainty that we're faced with right now. And I'd love to see clarity in everything, but that's not our reality. Our reality is things are going to be a little uncertain for a little while, as hopefully we continue to make effort at improving the metrics within our country. And in the meantime, we all get a chance to maybe hustle a little bit harder, and we all can experience some really good things that come out of it. We're always here for you. I've got this underlying belief that wealth is a choice. And I think that the more informed people are, the more they can make knowledgeable and educated decisions around their wealth, and therefore have an opportunity to have more of it. Thank you.
Ta-da!